everybody, and welcome to another edition of CapWealth On. When we were setting up the mic check for this episode, I was asked to say, how loud are you going to talk? And to give them an example, I said, how about the price of eggs? And that pretty much said it. So we're going to start off with today is this dominant theme of inflation that's kind of rifling through the economy, what it means. I'll break it down a little bit for you, and our response to it and how we incorporate that response into an investment strategy that'll help you all get through it. So let's look at the basic definition of inflation. Inflation is when you've got too many dollars chasing too few goods. That's where I started with my first economics course, and that has stood the time through my career. So let's break it into those two parts. The first one is too many dollars. What does the Federal Reserve have to do to get this too many dollars chasing too few goods part of the equation under control? Well, they've got two tools in the toolbox that they're focusing on. The first one is an increase in interest rates. And then the second one is shrinking the amount of dollars that they put into the economy in response to the pandemic. I've told you before, we've increased the amount of money that's in circulation by over 40% since 2020, early February of 2020. That's a staggering amount of money, and that is a chief component of this too many dollars chasing too few goods. So the Federal Reserve announced last quarter that they're going to begin the process of unwinding their balance sheet. Well, what does that mean, and how does that affect this supply of money? So when the Federal Reserve bought assets and they put them on their balance sheet, I think their balance sheet's over $6 trillion now, they essentially printed money to do that. So when they take those assets off their balance sheet and they sell them back into the marketplace, they're pulling money out of the economy. So they're starting to reverse the effect of that 40% increase in the money supply that took place from 2020 on. So that has been actually a two-step process. First thing they did was this thing called taper. They stopped buying assets, and now they're in the process of selling them down. So that will have a dramatic impact over time in the amount of money that's in circulation that's chasing the too few goods. The second part of this, and it's the more obvious one, is the increase in interest rates. So they increased interest rates 0.25% in the first quarter. They just increased them 0.5%. And the really good news about all of this is that with just a 0.75% increase in interest rates, they've created chaos in the financial markets, and everybody is upset, and they're taking them seriously. One of the problems that you have when you get into an inflationary cycle is breaking inflationary expectations. And what they've done and the way they've handled it so far, it's working, because we can see the end of speculation in the financial markets. Now, this still has a long way to go. Today they reported that the inflation rate moderated to 8.3%. Well, that's hardly recognizable from the 8.5% that was reported in the first quarter. But as people don't feel as wealthy, as they go through this process of not feeling as wealthy or as confident as they did, given the huge declines in the financial markets, and we'll talk more about that and the wealth effect and how that impacts them. But as they feel less confident, that's going to be reflected in how they act as consumers. And so I would not be surprised at all to see a dramatic decline in inflation because of the inflationary expectations of consumers starting to show up in the third and fourth quarter. That takes the pressure off of what the Federal Reserve has to do, because the consumer just won't be able to finance inflation like they have up to this point in time. We'll see it in a couple of other measurements that they'll follow. Just recently, they reported that the savings rate had the lowest rate of increase since 2013. Well, that tells you that people are starting to feel the impact of inflation. You know, the price of eggs, the price of meat, the things that they buy on a daily basis, fuel costs, all of those things have risen in addition to the interest rates that they have on any type of borrowing they may have. So that's the news, even though it's painful for some people that were speculating in the financial markets, the news is generally good in terms of where this could land and the soft landing that I still think we will have. So let's talk about the second component of this. Too many dollars chasing too few goods. What does the too few goods mean? Well, we've got two problems right now, and I'll illustrate it through the housing market, and I'll illustrate it through the chip market. The first part of this too few goods problems is an inventory problem. In 2020, we had 800,000 homes in inventory. In 2022, April, the same time period, 2 years later, we had 300,000 homes in inventory. So it's no different than if you went to the butcher and there's a shortage of tenderloin or a shortage of hamburger. That is going to cause an immediate increase in price because of those short-term inventory problems. Now, the longer-term supply problem, you go from inventory to supply, the longer-term supply problem in housing is that because we haven't finished the last piece of business from the financial crisis with housing finance reform, we haven't built enough single-family homes. And the best estimates are that we have a 5 million home shortage of single-family homes nationwide. So that creates an even longer-term problem that will be more difficult to bring under control. But it is manageable with two factors. Look at the cost, the components that go into the cost of a home. Lumber, appliances, other things like that. Those commodity prices will come down. And then the second component of it is the profit that a builder will make and the profit that these vendors will make as they sell these products and services. In the same hamburger example, if you've got less hamburger than there's current demand for, you get a bigger price for it because you can't sell as much as you'd ordinarily sell and you're trying to maintain your margins. So a lot of builders have gotten really fat in the last couple of years because they've been able to make margins that they've never had before because they can't build enough homes to satisfy demand. So those margins will come down over time. You know, I'm doing an interview tomorrow and they asked me to prepare for some ideas about what consumers can do to dull the impact of inflation right now, specifically with housing. Well, I would say don't buy a home right now unless you absolutely have to, and unless it's a great bargain relative to what it would cost to replace it today. Back away from the table. Don't get into that bidding war unless you have to, and then only if it makes sense, because prices will moderate over time. So the second example that I was going to illustrate is the chip supply, the semiconductors. And we have a current inventory problem because when we came out of the pandemic, there was a shortage of inventory because factories were shut down, and then all of a sudden demand, pent-up demand, resumed. And so that's created supply chain issues all across a lot of industries. Car industry is one of those. So that inventory problem exists, and it's created some disruptions that allowed car dealers again, who couldn't sell enough cars, it allowed them to get sticker plus 10 or 15 or 20%, some outrageous prices. They were just responding to the market. They couldn't sell enough cars to maintain normal profit margins, so they were able to sell what they could get at higher profit margins than they've ever experienced. So I would expect that short-term inventory problem will come down in a lot of industries that are affected by semiconductors and the chip industry. One of the revelations of the pandemic and the focus that was brought to the semiconductor industry is that as a country, we don't produce semiconductors. And so there's been this Manhattan Project with various companies, Intel is the one I'll talk the most about, in building domestic supply. Intel has 2 projects going on now where they will build out and manufacture chips in the United States. They're spending close to $50 billion on just 2 projects because longer term, the supply issues with semiconductors is not going away. You know, they say that the car of the future is going to be a computer chip over a set of 4 tires. And so the demand for computer chips is going to be in everything from your toaster to your cars, to the lighting systems in your homes. It's really fascinating how technology is evolving. So longer term, that supply issue is going to be troublesome, probably for the next 2 to 3 years. And then at some point in that time period, we'll be bringing on additional sources of supply, and some of those national security issues will even be will be addressed by domestic production of chips. So let's talk about this in the context of what it means for your investments. You know, when you look at the declines of the S&P 500, which is a broad market index of the largest 500 companies in the country, and then you look at the Dow Jones Industrial Average, which is a more focused industrial, new economy type approach to the largest companies in the country. And then you look at NASDAQ, which is a basket of 5,000 growing companies. What you see is a huge amount of decline in a relatively short period of time. And why has that happened? Well, all of these markets, all of these indexes are made up of individual companies. And part of the problem with too many dollars chasing too few goods hit the financial markets too. And so people were bidding up companies at prices we've never seen before, or since the last time we had a financial bubble like this, which I take all the way back to 2000. It's amazing how the parallels from 2000 to the present, 22 years later. The institutional memory of what happened in 2000 was completely forgotten by an entire generation of investors, and they've got caught. So they were paying $186 a share for a company like Peloton, which was undercapitalized, a product of the pandemic, and didn't have a sustainable stream of cash flow and earnings. That company was $12 a share a couple of days ago. And it was a complete misunderstanding of what they were capable of. There was a company called Roblox that was, tuned into a younger generation that was locked up at home, and they had time to build websites and build apps and all sorts of things, almost on a hobby type basis. Well, everybody was so excited about that, they drove the price of it up to $140. I think it was $24 at the close today. That happened with any number of companies. Netflix, which we really like as a company, and we just made a purchase in it. But it's dropped 75% in value this year. And there were supposedly some very smart people that thought it was a good idea at $700 a share. Now it's $175 a share. So why have we done better? Why have our losses been less than half of the S&P 500 and less than 20% of NASDAQ and even fare better than the Dow Jones Industrial Average? Why has the bond market had the worst year since 1842, when losses in bonds have actually exceeded in many cases that of stocks? Bonds are supposed to be conservative investments. You weren't supposed to lose money in bonds. And as you've heard me talk about this for the last 5 years, bonds made no sense, because if you can't get an inflation adjusted return on bonds, why would you own them? And so people were buying bonds with a 1%, 10-year treasury with a 1% yield in the latter part of 2020. And today, I think I mentioned it, the 10-year treasury is over 3%. So as those interest rates have gone up, the value of the bonds have gone down. So why have we done better? Well, it's our approach to customization, and it's our approach to how we look at markets as individual companies, individual securities, and individual investments that have to make sense relative to inflation and taxes and the other things that go into consideration. For example, how much money you have, what your tolerance for risk is, a lot of different factors. So why have we done better? Well, number one, for no specific reason, a large portion, our largest single set of investments was in the energy market. Chevron, Marathon Petroleum, Exxon for a short period of time, Williams companies with natural gas. That sector of the market's up 35% this year. So when your largest group of holdings is up 35%, it helps you offset the losses that you're going to have in other things. Another example would be the GSEs. You've heard me talk for years about Fannie Mae and Freddie Mac, and I'll get real technical with you for a minute. Fannie Mae and Freddie Mac are what you would describe in an MBA school as an asymmetric trade. They have $25 face value, and unless they just completely end those companies and they have to go through a receivership, you're going to get $25. And even in receivership, you might get $25, because unlike Peloton and unlike Roblox and these other companies that have no earnings and no capital and no sustainable business model, Fannie Mae and Freddie Mac made $25 billion last year between the two of them. They are the two most profitable companies in the world by employee. It's a very fascinating thing. So in addition to that being an asymmetric trade, the only variable that affects your return is the amount of time you have to hold it before you get that $25. The other factor is that it's a non-correlating asset, meaning it doesn't make any difference how people feel about NASDAQ or Roblox or anything else. It is how that investment is going to do based upon the factors that are going to allow them to come out of conservatorship and what the terms and conditions of that will be and the amount of time. So Fannie Mae and Freddie Mac, as we've approached this moment in time where the administrative reform and the legal aspect, the lawsuits that shareholders have brought, the first one will actually go to trial in July. As those factors have come together, the market got a little more positive. It looked like a really good value. So they're up over 30% this year. So we have two components of our account with this focus on value and this focus on sustainable earnings and profits that have caused our losses to be substantially less than the rest of the market. So you can take confidence in that. That's what we did in 2000 to 2003 during this last speculative bubble. And one of the great things about it if you've got assets that are going up, you can sell them and buy assets that have gone down at some point. In 2000, yeah, I've always been out of sync with the financial markets, but I was never any more out of sync than I was then, because my largest holding in 2000 was Genesco. Many of you remember that. And they were about ready to put me in a soft room because everybody owned Microsoft and all these high-tech companies. And why would you own a little shoe company in a period where everybody was making all this money in technology? Why? Because they were making money. Their basic business was good. They had a market in a little thing called Journeys that was on fire in outlet malls. It was, speaking to an entire generation of consumers, younger consumers, that nobody was addressing. And so while things like Microsoft, believe it or not, lost 90% of their value in that 10 or 15 year period, Genesco went from $2 or $3 a share. I gave the last 2,000 shares I owned to a charity at $50 a share. So having those assets that go up while everything else going down, the baby will get thrown out with the bathwater. And there will be good companies like Netflix, as an example, and others that we can make investments with as we rotate through. So we're on it, and we've been prepared for this. There's always things that you could have done better, but I think on balance, we're doing a really good job. This is where we shine. And I'll close with this. The buzz right now, and I wrote these down because I listened to the other pundits on financial channels. Everybody's saying that the focus now should be on well-capitalized companies with excess earnings that pay dividends, that have inelastic demand. You can't substitute their products or services, and they have the ability to raise their prices to cover inflation. Everybody says that now. Well, we don't just say it, we live it, and we've been living it. And that's the difference of why we're where we are over a 22-year period. And you guys make it easy. I've got the best group of clients, I would say, that you could find anywhere in any firm our size in the industry. And so, in just closing this out today, I want to thank you. Know that we've got this under control. We've made a commitment to doing it. And I think it's going to finish out and be a really great year for us, meaning a great year for you. Thank you.